Picture this, an index that measures the collective fear of millions of investors. When it spikes, Wall Street holds its breath. April 2025, Trump announces massive tariffs. Markets bloodbath, and one mysterious indicator rocketed to 60, levels not seen since COVID crashed the world economy. That indicator is the VIX. Wall Street calls it the fear index, and what it's telling us right now might be the most important market signal of 2026. By the end of this video, you will understand what the VIX is and how it translates invisible psychology into a single explosive signal. You are watching PragmaPerf. VIX. 3 letters. Maximum impact. Created in 1993 by the Chicago Board Options Exchange, nicknamed the Fear Index. But here is what most people get wrong. The VIX doesn't measure what happened yesterday. It measures what investors think will happen over the next 30 days. It's not about the past. It's about expected chaos. To understand how it works, we need to talk about options. Stay with me, I'll make this simple. Imagine you own Apple stock trading at $200. You're nervous, it might crash. What can you do? You buy insurance. In finance, that's called a put option. A put option gives you the right to sell your Apple shares at $200. Even if the price crashes to $150, you pay a premium, let's say $10. If Apple tanks to $150, you can still sell at $200. That put option just saved you $40 minus the $10 you paid for it. Now, here's the secret. The VIX is calculated based on prices of these options. When investors are calm, insurance is cheap. The VIX stays low, but when shock hits, like the April 2025 tariff announcement, everyone tries to buy insurance at the exact same time. Demand skyrockets. The price of put options goes to the moon, and because the VIX tracks those prices, it explodes. Wait, if it's about insurance against a crash, why do we call it volatility and not just the crash index? Because the formula does include call options, the bets that the market will go up. When things get wild, traders expect massive swings in both directions. Think of it like this. If you are in a boat on a calm lake, the volatility is zero. But if a storm hits, the boat doesn't just go down, it gets tossed up and down violently. The VIX measures the size of those waves. The exact math is a headache, but here is the essence. The VIX analyzes the prices of hundreds of S&P 500 options expiring in about 30 days. It looks at the out-of-the-money options, the ones that only pay out if there is a significant move, the ones most sensitive to fear. When those options suddenly become expensive, the VIX tells the world the storm is here. The formula calculates something called implied variance from these option prices. Higher option prices equal higher expected variance, which equals a higher VIX. The result is annualized and shown as a percentage. Example: a VIX of 20 means the market expects the S&P 500 to swing up or down by roughly 20% over the next year. Now, here is how to read the VIX levels. 0 to 12 is where everyone is very confident. 12 to 20 is the normal case. Markets are breathing normally. The historical average sits around 19. This is the VIX comfort zone during stable periods. 20 to 30, it's nervousness. Investors are starting to sweat. They are buying insurance just in case. 30 to 50 is fear, serious stress. Brexit happened right here. 50 plus is total panic, systemic crisis territory. COVID in March 2020 and April 2025. The all-time record? October 1987's Black Monday crash. The VIX hit 150. During COVID, it peaked at 82. Let me give you a quick math hack. The rule of 16. VIX at 16 divide by 16, the square root of 252 trading days. You get 1%. The market expects daily moves of about 1%. VIX at 32 expect 2% daily swings. VIX at 60, almost 4% moves per day. Let's rewind. April 2nd, 2025, Washington, D.C. President Trump announces Liberation Day. Massive reciprocal tariffs on almost every major US trading partners. Markets are still open. Algorithms react in milliseconds. Red everywhere. April 3rd. Wall Street opens. Carnage. The Dow, the S&P 500, the Nasdaq, all major indices plunge. But something else is happening behind the scenes. The VIX does something extremely rare. It rockets from around 20 on April 2nd to 60 in April 7. In just 5 days, its highest level since the March 2020 COVID panic. Investors were paying any price to buy options to protect themselves. And then, April 9th plot twist. Trump announces a 90-day pause on most tariffs. Markets explode upward. The VIX collapses back down. Notice the inverse dance. As the S&P 500 crashed during the tariff shock, the VIX skyrocketed. When Trump announced the pause, stocks rebounded and the VIX retreated. This is the VIX in action, capturing in real time the collective anxiety of investors. So, how should you interpret VIX signal? There are three main schools of thought. The contrarian view: high VIX equals buying opportunity, low VIX equals danger ahead. The logic: when the VIX spikes above 40, fear is maximal. Stocks might be oversold and due for a bounce. Conversely, when the VIX drops below 12, markets might be complacent and at risk of shocks. Buy when others are fearful, be cautious when others are greedy. Now, let's take a look at the trend following view. They use the VIX to confirm what's already happening. Rising VIX during a market decline, it validates real fear. Falling VIX during market's rally, it validates investors' confidence. Don't fight it. Follow the momentum. Now, the risk management view. Many institutional investors use the VIX purely for protection. VIX rising, add edges. VIX falling, reduce edges. Adjust portfolio insurance based on the market's fear level. Well, here's the truth. The VIX is one tool among many. Powerful, yes, but it should not be used in isolation. Context is everything. What is causing market volatility expectations? Is it short-term policy noise or real economic problems? So, let's bring it all together. The VIX isn't just a number on a screen. It's a window into psychology. It reveals whether investors are afraid or sleeping peacefully. April 2025, VIX at 60. Total panic. Now, beginning of 2026. Trump threatening tariffs. Iran tensions. Venezuela, Greenland, China, and the VIX around 20, right in the normal range. Not panic, but not too calm either. Just business as usual. But here is the question. Should we really feel normal right now? Or have we simply gotten used to living in chaos? Could such a VIX be like the ocean pulling back before a tsunami? Because the day Trump decides to fully implement those threats, or another shock hits the system, the VIX could explode again. If this video gave you a new lens on market psychology, hit that like button and subscribe. Turn on notifications so you don't miss the next deep dive. And drop a comment. Do you think the VIX will spike again in 2026, or will this calm hold until year end? See you in the next video.